Good morning. This is Melissa Napier from Conagra Brands. Thank you for listening to our prepared remarks on Conagra Brands' fourth quarter and fiscal year 2024 earnings. At 9:30 Eastern this morning, we will hold a separate live question and answer session on today's results, which you can access via webcast on our investor relations website. Our press release, presentation materials, and a transcript of these prepared remarks are also available there. I'm joined this morning by Sean Connolly, our CEO, and Dave Marberger, our CFO. We will be making some forward-looking statements today, and while we are making these statements in good faith based on current information, we do not have any guarantee about the results we will achieve. Descriptions of our risk factors are included in our filings with the SEC. We will also be discussing some non-GAAP financial measures. Please see our earnings release and slides for the GAAP to non-GAAP reconciliations and information on our comparability items, which can be found in the investor relations section of our website. And I'll now turn the call over to Sean.
Thanks, Melissa. Good morning, everyone. Thank you for joining our fourth quarter fiscal 24 earnings call. I'll begin today's call by sharing some perspective on our fourth quarter and fiscal 24 performance, particularly in the context of our broader environment. Then, before I turn it over to Dave, I'll discuss how we're thinking about fiscal 25. Let's get started with the key points we want to convey on slide 5. Overall, we demonstrated solid progress throughout fiscal 24 amidst a challenging consumer environment. In Q4, we continued to see positive impact from our investments to maximize consumer engagement with our brands. This again resulted in sequential volume improvement in our domestic retail business. We also saw strength in share, particularly in frozen and snacks, where our volume progress has been most meaningful. Even with these significant investments, we reported full-year adjusted gross and operating margin expansion supported by productivity improvements across our supply chain. Further, our strong free cash flow enabled us to continue to reduce our net leverage ratio and strengthen our balance sheet consistent with our goals. Our progress in 24 reinforces the strength and resiliency of our business. We expect fiscal 25 to be a continued transition toward a normalized operated environment. That means a gradual waning of the challenging industry trends seen throughout fiscal 24 as consumers adapt and establish new reference prices. In light of this, we've prudently tempered our fiscal 25 outlook. We'll provide more detail on that shortly. Let's turn to slide 6, which provides a snapshot of our fourth quarter and full year 2024 results. Heading into fiscal 24, we knew that the consumer environment was challenged, and it continued that way throughout the year. Against that backdrop, we remained agile, modified our plans, and made steady progress as the year unfolded. And while our ramped-up investments pressured dollar sales, they delivered the desired impact on volumes, as I will unpack for you in a moment. We also reported adjusted gross margin expansion of 58 basis points and adjusted operating margin expansion of 34 basis points over the prior year period, a two-year increase of 284 and 159 basis points, respectively. Although we saw one-year declines in organic net sales and adjusted EPS, our two-year organic net sales and adjusted EPS CAGRs remained solid at 2.2% and 6.4%, respectively. Before I dive deeper into the fiscal 24 results, I want to share some perspective about our progress over the last 5 years, shown here on slide 7. Our business today is substantially larger and more profitable than it was pre-COVID, and we've reported strong performance across each of our KPIs despite volatile market conditions. This reflects our efforts to deploy our playbook, which is focused on investing in our brands to sustain our share of mind and share of wallet with the consumer and drive profitable growth. As a result, we delivered an overall improvement in net sales, operating margins, and adjusted EPS, and our focus on maximizing free cash flow enabled us to reduce our net leverage from more than 5.5 times to less than 3.4 times, all while continuing to invest to make our brands stronger and far more resilient than they've ever been. That resiliency has been demonstrated more recently in the steady volume recovery we've delivered in our domestic retail business, illustrated here on slide 8. We still have some work to do, but you can see how volumes recovered significantly in the second half of the year. We anticipate the consumer environment will remain challenging in fiscal 25, but our proven ability to navigate today's difficult operating environment reinforces our confidence in continued volume progress from here. Critically, we have seen strong improvement in volume consumption trends in our key domains of snacks and frozen. As you can see, snacks returned to growth in Q4, with frozen knocking on the door. The resiliency of our portfolio is particularly evident when compared to the broader market. Slide 10 shows our strong share gains throughout fiscal 24. As you can see, in Q4, approximately 65% of our portfolio held or gained volume share amid a slow environment, marking the fourth consecutive quarter of share gains. It's worth noting that our share performance is even stronger within our highly strategic frozen and snacks domains, where an impressive 80% of our brands have held or gained volume share. And as you can see here on slide 11, our performance is highly competitive versus our near-end peers. Turning to slide 12 and looking at the results from our single largest category, frozen single-serve meals, our investments enabled us to drive steady improvement throughout fiscal 24, and in the fourth quarter, we returned to volume growth, significantly outpacing the category. In fact, that growth, behind our enhanced investments across frozen single-serve meals, has enabled us to deliver record share levels in the category, shown here on slide 13. Encouragingly, volume trends on Birds Eye frozen vegetables are also improving. Slide 14 shows Birds Eye's volume sales have improved faster than the total frozen vegetable category on a quarterly basis. This is particularly evident in the fourth quarter, as our volume sales performance significantly outpaced that of the total category. To wrap up on frozen, I want to reiterate the steady, solid growth of this category over the past 40 years. I know I've shared this slide in the past, but it bears repeating, as it's one of the many reasons we remain bullish on frozen. Frozen's 4% CAGR is in the top tier of foods growing in in-home consumption over this extended time frame. Now turning to our snacks business on slide 16. We saw strong momentum in the fourth quarter, while trends in snacking were down across several of our competitors. This is largely due to our on-trend snacking brands that span advantaged snacking subspaces like meat snacks, popcorn, and seeds. We've seen strong volume sales performance across each of these subcategories, given the rise of protein and fiber-centric snacking, as brands like Duke's, David, and Angie's Boom Chicka Pop have enabled us to answer consumer demands for healthier, on-trend snack options. Moving on to our staples domain on slide 17. While we saw an overall improvement in volume sales in the second half, we were wrapping supply chain disruptions in chili and canned meat, resulting in a 17.5% volume increase in Q4. We also saw brand building investments drive volume growth in certain previously challenged refrigerated products. As a result, as we enter fiscal 25, we'll make further prudent investments to stimulate broader volume recovery in staples. Despite the challenging macro environment the past year, our innovation continued to resonate with consumers in a big way. Slide 18 highlights some of our innovation that we launched during fiscal 24, as well as some items that will hit store shelves in fiscal 25. The expansion of our Bird's Eye brands to include delicious, culinary-inspired products that appeal to a younger, more affluent household has seen significant success in the market. Consumers have also embraced our Banquet Mega Chicken Fillets and Healthy Choice Modern Dinners, which cater to a greater variety of eating occasions. And finally, Wendy's Chili, delivering the flavors that consumers know and love from the QSR industry, became available at grocery stores nationwide, and it continues to perform very well for us. As I mentioned earlier, we delivered full-year adjusted gross and operating margin expansion, thanks in large part to our successful cost savings initiatives and strong supply chain productivity. These strong productivity results helped fuel the significant brand-building investments I've discussed here this morning. At the end of fiscal 24, savings as a percentage of cost of goods sold reached our long-term target of approximately 4%, and service levels improved close to pre-COVID levels at 97%. We also delivered substantial improvements in free cash flow and a 5-day improvement in our cash conversion cycle relative to the prior year period. As we look ahead to fiscal 25, we remain on track to deliver $1 billion of cost savings by the end of the year. Now, looking at the year ahead, we anticipate the consumer will remain challenged in fiscal 25, but that we will gradually transition toward a more normalized operating environment as consumers adapt. Here are our key assumptions for fiscal 25. We expect our brands will continue to benefit from our ongoing strategic investments to maximize consumer engagement and drive further volume improvements. We'll continue to drive our cost savings and productivity initiatives and expect to achieve 4% cost savings as a percentage of cost of goods sold. This will help offset projected inflation and further enhance our competitive position. For fiscal 25, we anticipate adjusted gross margins will remain stable despite continuing our brand-building investments. Further, while Ardent Mills is expected to deliver another strong year, it will not be at the level of a particularly strong fiscal 24. Turning now to our financial guidance for fiscal 25 on slide 23. Again, our outlook anticipates both continued investment in our brands and a gradual waning of the challenging macro trends experienced by the industry in fiscal 24 as consumers continue to establish new reference prices. We view this stance as prudent. Accordingly, we are guiding to an organic net sales range of minus 1.5% to flat compared to fiscal 24, adjusted operating margin of approximately 15.6 to 15.8%, and adjusted EPS of approximately $2.60 to $2.65. Our steady progress in 2024, despite a difficult consumer environment, demonstrates the underlying resiliency of our business, and this reinforces our confidence to drive further volume improvement and margin expansion in fiscal 25. With that, I'll pass the call over to Dave to discuss our financials in more detail.
Thanks, Sean, and good morning, everyone. As Sean discussed, we made solid progress throughout the fiscal year in a challenging consumer environment. I'll first highlight the full year results shown on slide 25 before discussing the fourth quarter. Fiscal 24 organic net sales of $12 billion were down 2.1%, largely driven by the industry-wide elongated volume recovery in our domestic retail business. Adjusted gross profit and adjusted operating profit both improved 0.3% over prior year despite lower sales, as strong supply chain productivity helped offset cost of goods sold inflation, absorption impacts from our lower volumes, and the brand investments we made during the year. Advertising and promotion expense as a percentage of net sales was consistent with last year at 2.4%. Adjusted SG&A, which excludes A&P, was approximately flat to the prior year, as general cost increases were mostly offset by lower incentive compensation expense. We delivered an adjusted operating margin of 16%, and adjusted EPS of $2.67 for the fiscal year. And as Sean mentioned, we finished the year at a net leverage ratio of 3.37 times and improved our free cash flow by approximately $1 billion over fiscal 23. I'll now discuss our fourth quarter results, starting with our net sales bridge on slide 26. Organic net sales declined 2.4%, driven by a volume decline of 1.8% and a 0.6% price mix reduction, reflecting the increased brand building investments. We also saw a small benefit from favorable foreign exchange. Slide 27 outlines Q4 top-line performance for each segment. Volume declines in our grocery and snacks and food service segments were partially offset by volume increases in our refrigerated and frozen and international segments for the quarter. As Sean discussed, we made good progress in our snacks business as consumption trends were positive in the quarter, helping us gain share. In grocery, we've seen positive results in select areas where we've increased investment and innovation, and we continue to evaluate prudent investment opportunities in our grocery business to improve volumes moving forward. We are pleased with the volume inflection we delivered in refrigerated and frozen in Q4, demonstrating the consumer impact of our trade investments. Declines in food service volume were driven by a slowdown in QSR traffic, along with actions we've been taking to eliminate low-profit business, which is reflected in the strong operating margin performance in food service that you will see shortly. Our international business delivered another strong sales quarter, with volume and price mix both up year over year, driven by strong results from our Mexico and global export businesses. Overall, we are seeing some green shoots from our frozen, snacking, and international volumes in Q4 and remain confident that our continued innovation, brand, and trade merchandising investments will help this continue in fiscal 25. The components of our Q4 adjusted operating margin bridge are shown on slide 28. Adjusted gross margin improved 62 basis points over prior year to 27.6%. Productivity improvements, which approximated 4% of cost of goods sold in the quarter, more than offset net inflation, which approximated 2.7% of cost of goods sold, which helped fund trade merchandising investments in our brands. Adjusted operating margin improved 22 basis points over prior year to 14.8%, driven by the adjusted gross margin improvement I just discussed, partially offset by increased A&P and adjusted SG&A. Slide 29 details our adjusted operating profit and adjusted operating margin performance by segment for Q4. Grocery and snacks adjusted operating margin improved 220 basis points, aided by pricing taken earlier in the fiscal year and by a $7 million net benefit related to insurance proceeds for prior year lost sales from our canned meats recall. Refrigerated and frozen adjusted operating margin declined 172 basis points from increased trade merchandising investments. International adjusted operating margins declined 283 basis points, mainly from transitory supply chain issues impacting our Canadian business, while food service adjusted operating margins improved 427 basis points, a result of discontinuing less profitable business. As a reminder, results from our annual goodwill and tangible impairment testing also negatively impacted reported profits, primarily in our refrigerated and frozen and grocery and snack segments. The primary drivers of the impairment charges were a combination of higher interest rates, revised net sales projections, and some market multiple contraction seen throughout the industry. The adjusted EPS bridges for the fourth quarter and full year are shown on slide 30. Fourth quarter adjusted EPS was 61 cents, a penny less than prior year. Taxes were favorable in the quarter by 2 cents, while a reduction in equity earnings from Ardent Mills was a 3-cent headwind. At the bottom half of the slide, you can see that our year-over-year EPS declined by 10 cents, largely driven by 7 cents of headwinds from additional interest expense and a reduction in pension income versus the prior year, as well as a 5-cent headwind from Ardent Mills as that business moves towards a more normalized level of operations. Let me take a minute to talk about our 44% joint venture ownership in Ardent Mills. Ardent Mills is a premier flour milling and ingredient company. The primary business of Ardent is in the milling and selling of flour products at a margin. Most of the remaining business is commodity revenue that is generated by managing volatility in grain markets through trading operations. The decrease in Ardent's fiscal 24 results reflects slightly lower volume trends in the milling industry and a move towards a more normalized commodity revenue environment, which hit record levels in fiscal 23. Slide 31 reiterates the progress we've made to strengthen our balance sheet and improve cash flow. In Q4, we repaid a $1 billion senior note that matured in May 2024 through a combination of cash on hand, commercial paper borrowings, and the issuance of a $300 million one-year unsecured term loan. For the fiscal year, our ending net debt was $8.4 billion, a reduction of $777 million or 8.5% from fiscal 23. We delivered strong year-over-year improvement in net cash flow from operating activities, primarily through reduced inventory balances and improved cash returns from Ardent Mills, generating $2 billion in net cash flow from operations and free cash flow of $1.6 billion, an improvement of approximately $1 billion over prior year. Capital expenditures increased 7% over prior year to $388 million, and we paid $659 million in dividends in fiscal 24. I'm very proud of these results, which reflect a focused commitment by the entire Conagra organization on cash flow. Reducing debt and lowering our net leverage ratio have been priorities for us. Slide 32 shows the consistent progress we've made, finishing fiscal 24 at a net leverage ratio of 3.37 times, well on our way to achieving our targeted 3 times leverage ratio by the end of fiscal 26. Sean already previewed the guidance metrics shown here on slide 33. For fiscal 25, we are expecting organic net sales growth to be flat to down 1.5% versus fiscal 24. Adjusted operating margin between 15.6% and 15.8%, and adjusted EPS between $2.60 and $2.65. The considerations underlying our fiscal 25 guidance are shown on slide 34. As Sean discussed earlier, we're encouraged by the steady volume improvement and market share gains we've seen from the investments put in place during fiscal 24, and we expect to continue these investments in fiscal 25. We are projecting approximately 3% net inflation in fiscal 25, capital expenditures of $500 million, and full-year gross productivity savings of approximately $350 million, or 4% of cost of goods sold. We expect operating margin of 15.6 to 15.8%, which is down from 16% in fiscal 24. This decline is driven by higher expected SG&A in fiscal 25, mostly from higher incentive compensation expense, which was down in fiscal 24. We expect to generate a free cash flow conversion of approximately 90% and further reduce our net leverage ratio to approximately 3.2 times by the end of fiscal 25. We expect to resume a minimal amount of share repurchases in fiscal 25 to offset dilution from our share-based equity incentive plans. In terms of how we expect the year to progress, we expect Q1 to deliver the lowest volume, top line, and adjusted gross margin of any quarter. While we still receive the benefit from pricing put in place in fiscal 24, Q1 will be impacted by continued brand building investments and wrapping on our highest top line quarter in the prior year. We are planning for sequential volume improvement each quarter after Q1 to achieve our full year sales guidance. Also, SG&A in the first quarter will face a headwind from wrapping the Q1 fiscal 24 adjustment to reduce incentive compensation expense. This morning, we announced that our board of directors authorized the continuation of the company's annualized dividend rate of $1.40 per share, a 53% dividend payout ratio based on the midpoint of our fiscal 25 EPS guidance, and in line with our targeted payout ratio. That concludes our prepared remarks for today's call. Thank you for your interest in Conagra Brands.
Good morning, everyone, and welcome to the Conagra Brands Q4 and fiscal year 2024 earnings conference call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star and then 1. To withdraw your questions, you may press star and 2. Please also note today's event is being recorded. At this time, I'd like to turn the floor over to Melissa Napier, Head of Investor Relations. Ma'am, please go ahead.
Thanks, Jamie. Good morning, everyone. Thanks for joining us today for our live question and answer session on today's results. Once again, I'm joined this morning by Sean Connolly, our CEO, and Dave Marberger, our CFO. We may be making some forward-looking statements and discussing non-GAAP financial measures during the session. Please see our earnings release, prepared remarks, presentation materials, and filings with the SEC, which can all be found in the Investor Relations section of our website for more information, including descriptions of our risk factors, GAAP to non-GAAP reconciliations, and information on our comparability items. We hope you all had a chance to listen this morning to our prepared remarks, and I'll now ask Jamie to introduce the first question.
And once again, if you would like to ask a question, please press star and 1. Our first question today comes from Andrew Lazar from Barclays. Please go ahead with your question.
Great. Thanks so much. Good morning, everybody.
Morning.
Morning.
Sean, you talked in the prepared remarks about, expecting a sort of a gradual transition in fiscal 25 to a more normal operating environment as consumers adjust their reference prices. And I know you've talked a lot through the back part of this last fiscal year that consumers were increasingly ready to sort of engage in your categories and just needed to be nudged a bit. And it seems like that adjustment's taking longer, not just for Conagra, obviously, but the industry at large. Why do you think that is? And is it going to require, or is it requiring more investment than maybe you initially anticipated? And obviously I ask because that's one of the, if not the biggest debate in the space right now.
Sure, Andrew. Here's how I think about that. The operative word is transition. It's a process. It's not an event. And as we showed in our charts today for Conagra, that process is working. You saw in the materials today steady positive inflection on our volume, which is the key metric for us for the past 3 quarters. And that indicates that our investments to nudge volumes back toward positive territory are successfully engaging consumers. And importantly, we were able to expand our margins despite that investment. So I was particularly pleased to see volume consumption growth in Q4 in our snacks business, in our largest frozen business, which is frozen meals, in our refrigerated business, and in our international business. All of those posted positive volume growth in the quarter. Grocery has a couple of businesses that will get more support in fiscal 25, but those investments are baked into our plans. So overall, we have been nudging. The nudging is working, but it is a transition. It's a process, and we've moved the needle meaningfully, and that will continue to move positive. But it's a transition. It's not one of these events where we sprinkle a little money on the consumer and they forget that they ever experienced runaway inflation. It's a period of adjustment, and for us, that is clearly happening.
Thanks for that. And then, I know a good portion of the negative year-over-year pricing in refrigerated and frozen is, I think, more pass-through on some refrigerated items. But I guess I'm more curious on what the pricing and competitive environment looks like in the frozen space specifically, and sort of how you see that playing out as we start the new fiscal year. Thanks so much.
Sure. Yeah, absolutely. Yeah, we invested in frozen. As a result, volume consumption in frozen overall is back to just about flat, again, with our largest frozen business, single-serve meals, already growing volume. And our shares there hit record highs, as you saw in the materials. Merchandising, advertising, and innovation have all contributed to that. So it's not been a situation where it's a price-based driver that is driving that positive news in the frozen business. It's all of those things. And with respect to the merchandising, for us, it's really been about quality display, and it's been about frequency, not about deep discounting. I think what you're seeing in frozen overall, and I called this out last year, is when we were at the peak of the inflationary period and people were having to make choices and trade-offs to make their household balance sheet work, they moved some of their purchases of convenience-oriented items toward more scratch cooking, and they kept their leftovers and things like that. The challenge with that is that consumers don't really like planning for meals. They don't like preparing meals. They don't like cleaning up after meals. So the need for convenience, that's why I showed that 40-year chart in our materials today, is as strong as it's ever been. And after the consumer has to cut back for a while, they grow weary of those workaround behaviors and they come flying back to convenience, which is why the investments we've made in frozen to nudge consumers have materialized, and we saw growth in our frozen single-serve meal business in the quarter. So I would say, this is a category, a space that has a 40-year compound annual growth rate of 4%, which I think is the highest department in the grocery store. We went through a challenging period last year where we saw some trading down. We put some targeted investments against it, and now we've seen real positive response and knocking on the door of positive over in our total frozen business overall, with key businesses like single-serve meals growing and Birds Eye gaining share again, which is great to see as well.
Thanks so much.
Our next question comes from Ken Goldman from JP Morgan. Please go ahead with your question.
Hi, good morning, and thank you. I wanted to first better understand the comment about the outlook being prudent. On the one hand, your sales and EPS guidance, lower than the street expected. I think that's helpful in, certainly setting a lower bar. On the other hand, as Andrew mentioned, your outlook requires volumes to accelerate, especially on a 2-year basis. And, you're relying on the consumer getting used to higher prices, as you mentioned, and we just haven't seen that yet. So I guess I'm just trying to dig in a little bit on where you think you're being most conservative in your modeling as you plan out.
Ken, I think it's important to, because you just say we haven't seen that yet. And look at the charts we demonstrated today. We absolutely have seen that. We have seen 3 straight quarters of volume trend improvement in our businesses. And in this most recent quarter, we saw snacks volume consumption that was positive. Our frozen meals consumption grew. Our refrigerated business volume consumption grew. Our international business grew. So we absolutely have seen traction, and we expect to see continued traction from here. We do not have one of the portfolios out there that some have where there just have been investments and there has not been movement and inflection in the volume line. We have had steady inflection, and a fair amount of the portfolio is already either close to flat or turning positive. So that's an encouraging thing, and it indicates that our investments are doing a good job of nudging the consumer along and engaging. With respect to the comment that the guidance is prudent, it's prudent in that it recognizes that consumer adaptation is a process and it's not an event. And therefore, it embeds some conservatism around consumer buying behavior, but also some flexibility for us to continue investing behind volume growth, which, by the way, as we've said from the beginning, is our top priority in terms of nurturing the long-term health of the business. So, given the slope of our volume trends for the last 3 quarters, we think the outlook is a prudent outlook. We had no desire to try to be heroic with our guide for fiscal 25. I think, if you really just digest the progress we've made on these discrete businesses where we've placed investment, I think you can only conclude that it's a prudent play.
Thank you for that. And then for my follow-up, I wanted to clarify the first quarter outlook. Is the messaging first that the gross margin on an absolute level will be down or will be the lowest of the year, or is that year on year? I just wanted to clarify the gross margin comment. And then more broadly, you talked about volume, gross margin, tough SG&A lap. It certainly seems like consensus of 65 cents or so may need to come down a bit. So understanding you don't provide quarterly specifics, just trying to get maybe a slightly tighter sense of where you think some of the puts and takes in 1Q will be, just so maybe investor expectations are properly aligned with yours.
Yeah, Ken, this is Dave. Let me give you some color on that. So if you look at Q1 a year ago, that was the last quarter where we had significant price mix, right? So around the mid-single digit period. So we're wrapping on that quarter. So if you break it down, if you look at our domestic retail business, we expect improvement in volumes, but they're still going to be down year on year. But we expect improvement versus where we came in at Q4 in terms of volumes. Our international business, we actually expect to be lower. We called out some supply chain issues in Canada, and that will impact some of the business in Q1. So we expect Q1 sales year-on-year growth in Canada to be lower than it was in Q4. A couple of things in terms of the margin side. SG&A, we're going to have much higher SG&A in Q1 this year versus last year. Last year, we had an accrual to take down our incentive compensation. So year-on-year, that's a bounce back, and you're going to see that in expense. And that obviously is going to depress operating margin. And then on the gross margin side, Q1 is a lower sales quarter for us than other quarters. So you do normally get a little bit of drag from fixed costs relative to the other quarters. And we have the higher trade investments kind of rolling in from the end of last year. But as we said, and Sean said in his comments, we expect gross margins to be stable for the full year. So, we're pleased with the productivity. We expect that to continue. Inflation, we called for 3% net for the year. So, the benefit there helps us fund the additional investment that we're going to make. So all those things together, that hopefully gives you some color on our Q1.
Thank you very much.
Our next question comes from David Palmer from Evercore ISI. Please go ahead with your question.
Thanks. I wanted just to ask you about the challenging environment comments. You made that comment a few times during the prepared remarks, but sometimes we can assume what you mean by that, but I would assume also that there's going to be some differences in the types of challenges you see per category. I sense that you might have more category issues, for example, in entrees, but that you speak to price gap issues, perhaps in vegetables, for example. So could you speak specifically to what those challenges you're talking about and the types of investments that you're making, whether that's just price adjustments through promotion, display, or other activity?
Yeah, David, sure. Today in our material, as an example, to your point, I shared the consumption trends for our frozen business, and I showed a line chart that showed our consumption in Q1 was a -7.5, and in Q4 it was almost flat, and it's pretty much a straight line from Q1 through Q4. So the volume decline in that business is virtually gone over the course of 3 periods, and that did not happen by accident. You'll recall that after Q1, we made some, I'll call it, test investments in frozen to try to nudge the consumer along to see if it would work, and we got a great response to that in Q2. We expanded those investments in Q3. It was a combination of everything from advertising to merchandising to more support for our innovation, and it all had the desired effect. I think the types of merchandising that you'd look at really, as I mentioned earlier, were high-quality displays. As we say almost every quarter, the overall merchandising level in the last couple of years was down substantially versus pre-COVID. Now it's moving back in line with kind of where we've been historically. But the type of promotion is, and I'd say in the industry in general, has been pretty high quality. It's been, I would describe it as reasonable. We always have a keen sense for what are the more than price gaps in frozen, David. It's price thresholds. What thresholds can we hit that drive maximum lifts so we can, and we know where those are. We've hit those. That's why we've basically wiped out the volume declines in the frozen business, because we know what thresholds are particularly important. And the reason the consumer is ready to be nudged in the frozen business, as an example, is because that 40-year chart shows it. People rely on high quality, good tasting prepared foods that don't require any prep time and don't require any cleanup. When they're forced to, they might have to trim those purchases a little, as we experienced a couple of years ago in the last year, but they typically come roaring back, and that's kind of what's happened on the business. And that's the strategy that we'll have across the portfolio. Is we'll look at, to your point, category by category around what are the key thresholds that we need to hit to maximize our engagement. Some categories are more price gap oriented, and those tend to be categories where there are really just a couple of competitors. So canned tomatoes is a good example where that's more of a price gap type of category than others. But most of our categories are more about high quality display and hitting the right thresholds.
And just one follow-up on thanks for that, by the way. On A&P margin, do you imagine that being close to the 2.4% level this year again? And maybe is this the type of year that maybe advertising isn't as much of the priority, but maybe that starts to step up in future years? How are you thinking about advertising in the path going forward?
About the same.
Yeah.
Thanks very much.
Yep.
Our next question comes from Peter Galbo from Bank of America. Please go ahead with your question.
Hey guys, good morning. Thanks for taking the question. Dave, just kind of going through your comments, if we take kind of the productivity savings, none of the inflation, right? It's roughly, I think, $85 million that'll kind of get reinvested back into brand investment or price. Can you just verify that math kind of checks out on your end, and B, just give us a sense maybe, this being kind of incremental investment, where in the segments it's going to hit? Is it more weighted to refrigerated or more weighted to grocery? Any kind of color there would be helpful.
Yeah, why don't I hit that, and then I'll let Sean fill in any blanks. So yeah, from a high level, we're really pleased with our productivity. We talked about expecting 4% productivity, and inflation we estimate around 3%. So clearly there's some benefit there. And we expect stable gross margins for the full year. That allows us to make investments. Those investments will be continued investment in certain trade merchandising, which obviously impacts margin. And Sean just described how we go about that. Obviously, frozen and snacking are our priorities, but we also have select opportunities in grocery that we're evaluating that we think are important. But we also have other investments that we make that hit cost of goods sold in terms of continue innovation and product quality that we build in, other investments that we're making in the supply chain. Those do hit cost of goods sold and then are part of that whole margin basket. So, high level, we feel really good about the efficiency of the operation right now, where we can invest to get the volumes continuing to go in the right direction and maintain the gross margin that we finished fiscal 24.
Got it. Okay, that's helpful. And then, Sean, just kind of thinking about, the productivity number, and it's a question that's being asked of your peers as well. I guess just what's the risk that, we start to push the productivity lever too hard, and does that create, I don't know, lower ingredient quality or potential issues just as you're kind of getting maybe too productive? I think it's a question that we face a lot as well. So thanks very much.
Yeah, I think our investors should know that that's like the third rail for us. We would not cut quality of our products and worsen the consumer experience to drive productivity. In fact, if you look, Pete, over what we've done over the last 10 years, it's exactly the opposite of that. We have infused tons of money into our food quality and our packaging to modernize this portfolio, to make it the kind of stuff that people are willing to pay more for and conclude that it's a better value than when it was lower quality and lower price. And so that is precious for us. That is central to our innovation success that we've had. And that is not the kind of productivity we're talking about. We're talking about really a lot of what we've been doing is not only just getting our service levels back and our labor pool stable, but investing in technology and harnessing technology so we can run our plants more efficiently and really kind of do the opposite, which is have zero loss and no waste and be as high quality as we can be. So rest assured that's not part of the playbook.
Thanks, Sean. Thanks, guys.
Our next question comes from Max Gumport from BNP. Please go ahead with your question.
Hey, thanks for the question. I might be reading a bit too much into it, but it feels like while you're still encouraged by the direction of the volume recovery, you're maybe a bit less optimistic on the pace of that recovery than you were just last quarter, when it felt like you were moving towards that Mendoza line of flat to positive volumes. If that's right, could you just give us an update on sort of what's changed over the last 3 months in terms of what you're seeing in the consumer environment? Thanks.
Yeah, that's not right, Max. That's not how I feel at all. In fact, if you look at the trends of the consumption that we've shown, there has not been a business that has stalled. We've had steady upward trajectory from Q1 through Q4, just virtually everywhere in the business. Now, as Dave points out, there's plenty of noise in this year's Q1, so I get that we've got to be helpful for you guys and understand Q1. For example, part of that is not just on the stuff that impacts margin, but we've got some significant merchandising events in Q1 of last year that we've shifted to Q2 this year to take more advantage of holiday and the lifts we get there. So I feel like what we're seeing here is as I mentioned to Andrew and Ken, a process that's unfolding in a fairly linear way, ex the noise, in terms of just the underlying trend line. And I think that's going to continue. And I think, these are discrete investments that we put business by business, and where we've done that, we've seen a response. So we'll do that against more businesses, as we go into fiscal 25 here, and I think we'll see a continued response. And meanwhile, while we're doing it, if you think about our two most critical strategic businesses in the portfolio, frozen and snacks, we held or grew market share in 80% of those two of that combined business. That is about the best you're going to find in the industry. So these are not only bending the volume line in a very predictable way, but we are gaining share, and that just shows you how well our brands are resonating vis-a-vis their competitors, and how well our innovation is resonating with consumers as well.
Great. Then on food service with volumes down 10% in the quarter, you called out the QSR weakness as well as some actions to eliminate a low profit business. I was just curious if you could disaggregate for us the magnitude of each of those two impacts, and also what you're seeing on the QSR side in terms of how that weakness could progress over the coming year. Thanks. I'll leave it there.
I'll just make a quick comment here, and Dave, you add whatever you want. But our food service, I think everybody knows, as a channel, weakened, in the last several months. The traffic's been down, and no company, I think, has been exempt from that. But so we've had a bit of that, but that's really kind of not the big part of what you're seeing in our food service business. We have had a very serious margin expansion philosophy on our food service business, where in the last year we exercised a fair amount of value over volume strategy, and so that negatively pressured our volumes. But I think our operating margin in food service is up a massive amount, Dave. I don't know if we want to quantify that, but 400 basis points. So we've gotten the impact we were looking for from our value over volume. The top line part is a little bit soft attributable to the traffic piece that we've seen elsewhere, but the overall takeaway around top line food service, the primary driver is our value over volume strategy, and that has had a very material expansion on our operating margins there. Anything else you'd add to that?
Yeah, no, I was just going to say majority of the volume decline is from the discontinuation. It's been mostly in bulk popcorn and some tomato businesses where weren't making the money that we wanted to make, so we get out of those businesses.
Great. Thanks very much.
Our next question comes from Robert Moskow from TD Cowen. Please go ahead with your question.
Hi, thank you. Sean, you have a lot of brands that skew more heavily towards lower income consumers. You have a lot of brands that skew the other way. Are you seeing any differences in terms of how those brands are performing, like low income versus high income? Because look, there's a lot of when food companies are asking why things are slowing, they tend to point to that cohort, and you have a pretty broad portfolio. So do you see more in one versus the other?
Yeah, I think any large diversified food company is going to sell products to pretty much every income level. And I think the headline in the last year is that value-seeking behavior was not exempt from any income level. And part of that was just grounded in reality. People had to make their household balance sheet work for them. Part of it was principle. Even higher income consumers, just on principle, didn't like the new price points they were seeing in the basket, and they would trim their normal purchases. So to get to your point, it's things like, when we looked at SNAP and some of the sunsetting of the excess payments, did we see any material impact in the business? Not really. A little bit, but not much. So I would say that the value-seeking behavior we saw in the last year really was across income cohorts. You're always going to have more sensitivity for the lowest income bracket, and that's where you tend to see those thresholds that I talked about a little earlier with Dave matter the most, Rob, because if you are going to invest in a high-quality merchandising event and you can get to a meaningful threshold for that lower income consumer, it tends to manifest itself in high lifts. And where we've done that, we have seen higher lifts than we've seen on average kind of in the last 10 years. And I think what that tells you is, people who have trimmed their buying rate are ready to get back to that buying rate. They just need a little bit of that nudging. And I think those thresholds probably mean the most to the people who need them the most.
Great. Thank you.
Thanks.
Our next question comes from Nik Modi from RBC. Please go ahead with your question.
Thanks. Good morning, everyone. I just maybe I can just follow up on Rob's question, from a different angle. And Sean, I'd love your perspective on this. I mean, I'm wondering if there's a mismatch between, where the consumers are versus how you're spending. I mean, Conagra's been very on the forefront of digital, marketing for many years, but it seems like a lot of older consumers, tend to over-index to your categories. And I'm curious if you think there's a mismatch between where you're spending the money, which is more digital, versus kind of more traditional media, which is where some of these older consumers tend to traffic. Any thoughts on that?
Well, if you think about what I'll call our brand building spend in total, by far the biggest investment we make is in new product innovation, product and package. So it's actually right into the COGS line. And if you look across the food space, you won't probably find the breadth of innovation that we do around here. Why does that matter? Because the consumer spends the bulk of their time, shopping, whether it's shopping online or shopping in the store, and we want our products to be arresting at the point of purchase. We want our products to be provocative, to look modern and contemporary, because we believe that appeals to all age groups, young, middle, older, it doesn't matter. So that's our biggest spend. And then we also invest with our customers. We invest in high quality display. We invest in the proper shelving, the right eye level. And again, that's the kind of investment that is agnostic to age group. And the smallest piece of it is the A&P piece of it, which is heavily focused on the social media realm. And the reason for that is because we're trying to drive virality. We're trying to get word of mouth about our products. And just because virality may start online in TikTok or on Instagram, it doesn't end there. The point of those types of investments is they get consumers talking. And when you get consumers talking, they talk to their friends, they talk to their families, they talk to their moms and their dads. And that's how you drive brand saliency, top of mindness, and intrigue in the new innovation. So we have investments all across the board, from product to in-store to online, and we're highly confident we're reaching every demographic. And frankly, if we weren't, you would not have seen the types of volume inflection that we've seen across each of our consumer domains.
Great, that's helpful. And then just maybe you can give us an update on Slim Jim, and some of the channel work would suggest there's some pressure there, some kind of encroaching competitors like Fatty's. I'm just curious if you have any perspective on kind of how that brand is faring right now.
Yeah, I think to kind of wrap your mind around Slim Jim, you got to think Slim Jim enjoyed absolutely explosive growth through the pandemic, which saw the business increase in size dramatically. That led to some capacity constraints for us. And so between this past year, between the capacity constraints and the tough comps, those are things we had to deal with in fiscal 24. But now, with good investment, good innovation and capacity available to us again, the business is already growing again volumetrically, and I would expect that to continue. Slim Jim is a billion-dollar juggernaut, and that's not going to change.
Great. I'll pass it on. Thank you.
Thanks.
Our next question comes from Tom Palmer from Citi. Please go ahead with your question.
Hey, thanks for fitting me in. I just wanted to clarify on promotional activity and other types of brand building that you've referenced. How does the response of consumers compare to historical norms and relative to what we might have seen, say, in late 2023? And then are you seeing much response from your competitors based on your actions?
I would say on the categories where we've invested, the lifts have been better. And the way I describe that to folks is there's kind of a longing for some of these businesses if you've cut back on them. So, if your normal buying rate when you go to a store for a frozen meal is 10 and you cut that back to 8, that means that after you run out after 8, people in the household are opening the freezer expecting there to be 2 more, and instead they've got to make a sandwich from scratch or they got to cook something, and that grows frustrating. And so what happens then is if we can get to the right price thresholds and get a high quality display, people are like, oh, thank goodness, now I'm going to replenish it in my normal cadence. And that's kind of what we've seen. So it shows up in better lifts. In terms of competition across the category, look, everybody, I think, in the industry is trying to get volumes north again. And so I think everybody has had room to do more promotion. And that's fine. That's fine because the consumer needs some help, and I think they're getting it. But not everybody has equal brands, so you're not going to get equal lifts. And in frozen, as an example, look at our market shares there. We're at all-time record market shares. We're the biggest frozen player there is, and that's in large part, and all the category growth in the last 10 years is because of the quality of the innovation, which frankly is just difficult for anybody to match.
Thanks for that. And then just a quick one on Ardent Mills. The language in the release, or the prepared remarks at least, referred to it as moving towards a more normalized level of operations. I just want to make sure I understand this. Should we think about that $150 million outlook, which is kind of consistent with how you started off last year as well, as a more normalized rate, or is that like normalizing and we should look for maybe a glide path slightly lower over a series of years?
Yeah, Tom, let me try to give you some color on that. I did spend a little time in the remarks on Ardent Mills. It's really, split into 2 basic businesses, just the flour business that they sell at a margin, and then this business that I called commodity revenue type business. And this is, things like, them hedging, flour transactions, storing wheat, based on futures curves, speculating on feed prices and wheat and corn futures. So all that kind of, trading activity, that is very difficult to forecast with precision, right? And Ardent Mills they have, significant capability in the area. And so the way that we're going to do this with Ardent Mills is we're going to give you guidance on what the number is based on our latest estimate, from management. And then each quarter we're going to update on it because it can ebb and flow. But over the course of the year, right now, the guidance we gave is our best estimate.
Okay. Thank you for that.
Our next question comes from Chris Carey from Wells Fargo. Please go ahead with your question.
Hey, thank you very much. So I just wanted to maybe clarify, or not clarify, but get a bit more context on the pricing comments in the presentation around tomato-based pricing will be lapping, and then you'll be taking new pricing on some cocoa. I guess when you think about those 2 things, does that net out neutral for the year? And then how would you see overall pricing trending, perhaps X those items for the broader business? And I specifically ask that in the context of the stable gross margin, despite some of these investments. And then I have a quick follow-up.
Well, let me start, Sean, you can fill in. So, all of our pricing is inflation justified. So we've obviously taken significant pricing over the last 2 to 3 years, But you look in fiscal 24, there was significant inflation in tomatoes, so we took pricing during fiscal 24. So, that we will wrap on that in fiscal 25. And then, as you know, there's been significant inflation in cocoa. So with our Swiss Miss business, we have pricing that will be effective Q2. So that's, it's all based on inflation. So they're really the two big areas right now. In terms of, the impact on price mix, they're obviously, tailwinds to price mix, right? So when you take prices, you're going to get benefit from that. But then when we increase investment in trade merchandising, that's within the net sales line. So that shows up as more of a headwind in terms of the overall impact. So those will net. So as we go into fiscal 25, you'll start to see kind of price mix play out for our grocery and snacks business. Sean mentioned, we see some select opportunities in grocery where we want to do some investment. And so, that will play out as fiscal 25 moves on, and that will be reflected in the price mix line. So we're not going to give specific guidance, on price mix by segment, but they're the general dynamics that should help you.
Okay, great. I said it would be a quick follow-up. Maybe it'd be a bit more than that, but we'll see. So, 80% holding or gaining share on the strategic frozen and snacks, clearly very good share momentum in those areas where you're focused. You did, however, mention that staples is a work in progress. Can you just comment on the areas where you are seeing competitive encroachment, and perhaps specifically how you see private label developing in some of these areas, given the stepped-up retailer focus? Just any context on this that comes to mind is helpful. Thank you.
Yeah, we've as I mentioned, we've seen value-seeking behavior now for a couple of years, and it really is in every category that people buy in food and beyond food. We've tackled much of that in the portfolio. There are still some places that we haven't pursued that. So we got a couple of canned food businesses, as an example, with tomatoes and canned pasta, where we haven't put a lot of attention. Those are categories that they're not like other categories. They're not exempt from a trade down if your price thresholds are not right, if your gaps are not right. So, we've got, we've a vast portfolio. We've got a handful of spaces, not many, that we haven't really put energy against, that we'll put some investment against. That's baked into the outlook that we gave you today. And we know on those businesses, they are the kinds of businesses we talked about earlier, where when you get your fundamentals in the right spot, be it a gap or be it a threshold, and you get the right kind of display support, you tend to see outsized lift. So there are a few spaces there. But overall, I mean, if you think about the peer set, our strategic spaces are back to pretty much flat. We're already growing volumetrically. I don't think you're seeing that in a lot of other portfolios. And I also don't think that you're seeing in other folks' key strategic domains, 80% of that portfolio holding or gaining share. So, I want to make sure we emphasize that, because we were one of the first companies to say that we were going to, we said overtly, we're going to target our key strategic domains for investment since we believed the consumer was ready to be nudged. And we have seen tremendous response. We're back to pretty close to that Mendoza line, and in some cases already in positive territory there. So that, between that and our share performance in those strategic domains, I like the setup as we go into the fiscal year. We'll deal with the noise in Q1, but the fundamentals look pretty solid to my eyes.
Okay. All right. Thank you both.
Thanks.
And our next question is Rob Dickerson from Jefferies. Please go ahead with your question.
Great. Thanks so much. I guess, Sean, just to come back to the grocery, maybe, more staples business, it does seem like it's lagging a little bit, for the various reasons you mentioned, and, a bit more, investment going in there as we get through the year. But I am just curious, kind of, much more broadly speaking, if we go back kind of to pre-COVID, right? Kind of as you entered the company and, we looked through all the different, brands, and segments, there did seem to be, kind of a bit of a potential, divestment, on some of those grocery brands just to kind of focus the overall portfolio, right? And then we come back and say, okay, well, 80%, holding, getting share in the strategic domains, this is our focus. So, I'm just curious, as you think forward, the next few years, like I guess why not just kind of step away, from some of those brands, kind of in line with what you've been speaking about on the food service side? Thank you.
Yeah, there's a bunch in there, Rob. Let me just mention real quick on the first part in terms of our what we call our staples domain, which are basically staple products. For us, that's combination of refrigerated businesses and some grocery businesses. And we invested in some of the refrigerated businesses in Q4 and actually saw our refrigerated brands grow volumetrically. In our grocery business, we had some businesses that were wrapping an easy comp because of some supply chain challenges last year. They grew meaningfully in Q4. And then we had some other businesses that I just mentioned a couple that we've got to get to. So there's a lot that goes in there. We also under-shipped consumption in that grocery at Saks business in Q4. So that was really a part of what you saw in terms of where we stood versus consensus in the quarter. But to your broader point, if you go back to the deck we shared at the last CAGNY, I don't know that there's been a more active portfolio in the last 9 or so years in terms of reshaping the portfolio for better growth and better margins, including divestitures. We've done as many spins or divestitures as I think about anybody. So we're always open to that. I think what I would want investors to assume is, anything that's not strategic for us, where somebody else would offer us something that is above the intrinsic value of the asset, why wouldn't we be open to that? Of course, we have been in the past. We would be again in the future. But we also have to be, we have to have sharp pencils in terms of how much overhead do those assets absorb? What would the margin? What is the economic value we would lose if we were to exit them, and are we going to be paid for that? So you won't find any entrenchment here against the concept, but we have to be very buttoned up in terms of, does it create value or does it destroy value for our shareholders? Because over time, I think what you'll see is we invest in the businesses we own. We'll add bolt-ons that are additive to our growth and to our margin, and we'll divest stuff that is a drag either on growth or margin and not a strategic fit. I think that's always been our playbook, and I don't think that will change over time.
Got it. Yeah, fair enough. And then just maybe quickly for Dave, I normally don't ask about impairments, but clearly, called out this quarter, and I think, that some have been called out previously. While I understand, changes in rates, what have you, are there certain areas that we should just be aware of, or certain brands that maybe have been driving a bit more of those impairments? And that's all. Thank you.
Yep. No, Rob. So yeah, obviously, the fourth quarter, we go through our impairment testing. We do it every year. And we really look at impairment both at the brand level and for goodwill, which is based on a reporting level, which means there's several different brands that come together that then go against goodwill that's been allocated to those. So it's two different types of impairment. This quarter, we actually had impairments both in brands and in goodwill. And as I mentioned in my comments, there were three key drivers: that the higher interest rates, which obviously impact discount rates, because you're basically doing discounted cash flows when you do impairment on goodwill, and you're using a royalty method, which essentially is a discounted cash flow type concept. So obviously discount rates have an impact, and they're up based on interest rates. You also, when you do goodwill, you look at the industry market multiples, and that is something that impacted this year as part of the impairment. When you look at the food industry and you look at it as an average, that we have much lower industry market multiples. So that actually impacted us and was part of our impairment that we took. And then the third piece is assumptions we have on net sales. And obviously in this environment where, we're volumes are down, we're investing, that does impact your short-term forecasts on net sales. And, when you do that, that can impact any particular reporting unit or brand, depending on kind of where it sits. So, we feel great about our business. We talk about our business, very openly. And you guys have a very good feel for what our strategic priorities are. This is the standard analysis that we go through. But but more than 50% of the impact is really from the interest rates and the lower market multiple.
All right. All makes sense. Thank you so much.
Thanks.
And ladies and gentlemen, at this time, and showing no additional questions, I'd like to turn the floor back over to Melissa Napier for closing remarks.
Thanks everyone for joining us for our live Q&A session today. Investor Relations is around and available to take any follow-up questions that you may have. Have a good day, everyone. Thank you.
Ladies and gentlemen, that does conclude today's conference call. We do thank you for attending. You may now disconnect your lines.